welcome to episode 16 of Property Investing for Doctors and the Property Prescription.
We're really ticking along.
Ready to go. How was your break, Tony?
Break was good. I was in New Zealand for Christmas and New Year's. For those who don't know, I'm actually from New Zealand.
Are you?
Yeah. Well, I grew up in China until I was 9 and moved to New Zealand and then came to Australia when I was 15. But my formative years were in New Zealand.
And your wife's from New Zealand?
My wife's from New Zealand as well. She's from a little town called Rohuru. Has 200 people. It's right on the base of a huge volcano called Mount Taranaki.
Wow.
So every time we go back to visit her family, we stay on the base of the volcano. It's very cool.
Fantastic. And anywhere else travelled?
No, just around New Zealand. Really love New Zealand. It's quite scenic. If the economy was better, I'll be there for sure.
We've got to celebrate a big event, big milestone. Do you want to share
Yeah,
with our
we just
audience?
turned 40, which is interesting. I mean, I was thinking about this the other day. I moved to Australia when I was 15, and it was just a few days before millennium, so 2000. And I remember I was standing on the banks of the Yarra and the fireworks was going up, and I was thinking what the next 20, 30 years would be like. And it's very difficult to imagine yourself this far down the track. So now I'm 40, I'm thinking what the next 20 years will be like. I mean, you just can't imagine. Also my kids, right, because they're still young. I wonder what they're going to be like when they're 40. So it's just incredible. So it's something that can't really imagine. And I'm in a very fortunate place right now. Because back in the day when we first moved to Australia, we were quite poor. And now, via education and a bit of luck and some help from you guys, it's really, now I'm financially much more secure and looking forward to the next 40 years.
Yeah, but money doesn't resolve everything. At least you've still got to enjoy your life and travel. And I think you're a big traveller, which is great. So I really resonate with that part of it. And going on adventures and exploring new countries is part of it as well. So you gotta live your life.
I think this year for me, I'm going to focus more on my health.
Okay.
Getting old.
What are the goals? Give me the goals.
Not specific.
Okay.
But I bought myself a home gym.
Well done.
I'm rowing every day. I've got a rowing machine. My cholesterol's a little bit high. I'm going to get that down. And mental health as well.
Okay.
So my job is quite stressful. So I'm trying to calm myself down there. Mental, physical health, and spending time with my family.
Yeah.
So those are the key.
Yeah, and this is a bit off topic, but what are you doing for your mental health in terms of what are some of the exercises?
I started seeing my GP. We're talking more openly about mental health. I was quite worried about finances last year, and we did speak a lot. And you actually did help me with my mental health a lot.
Yeah.
So calm me down a lot about that. Have a plan about where my finances were. I mean, I'm quite fortunate when I don't really need to worry about it, but I think everyone still worries about money. So once I get rid of that part, I just want to make sure I'm healthy. So those are the two big things, health and wealth, and get that established and have a plan properly this year. So when I'm 40 now, I'm going to be mature about it and have a pathway.
Fantastic. Yeah. I think it's really important with our doctors. They're overstressed, they're overworked. You can be physically, everyone has these physical goals in terms of getting fit, losing weight, but no one talks about their mental health. And I think it's a really, really big topic. And I think you do need to put work in terms of working on your mental health as well. Because if you're not happy, at the end of the day, you become miserable. And that miserable behavior then resonates with your kids, and it's just this really bad flow-on effect. So I think it's good good on you. All right, well, let's get into the property. So there are a few questions on the sort of Property Investing for Doctors Facebook group, and it'd be really good to go through some of the technical aspects of those. So first question, how does inflation erode the real value of cash savings? So there was a lot of topical discussions around inflation, cash drag, and the real cost of waiting in terms of buying your house or starting to invest.
Can you explain what the term cash drag means?
Yeah, so cash drag occurs when money sits idle. This is the technical, I'm going to read this. Cash drag occurs when money sits idle and grows slower than inflation or asset prices.
Right.
So basically, if you've got just cash sitting there and inflation increases by more than 3 or 4%, you're actually losing the valuation of that cash just sitting in your cash account. So you've got to put it to work, and it can go into any form of investment, but but put it into the offset account if you've got debt on the family home. So I think you've got to, these are the key stats. So the mean price of Australian dwellings rose by $23,000 in just one quarter. That's 23 grand in one quarter. That's September to $1,045,000. The annual national house prices increased by 9.9% in 2025. So that's just in 1 year. So that means if you had a $1.5 million target home, that would rise by $150,000 in 1 year. You know, so the question is, can you save that amount of money within that particular period? So it's really important to say, if you've just got money sitting in cash and it's not doing anything, you've got to put it to work. And it doesn't have to be property. Put it into investments or get it working harder for you. And a lot of our doctors do that. You know, that's that cash drag sort of element in it. I think the other real question that we had was probably number one on our play sheet was, how does inflation erode the real value of cash savings? So that's another question. So do you understand that?
What's most obvious to me would be $1,000 today is very different to $1,000 10 years ago.
Correct.
So obviously I cannot buy, I mean, you can see it going to the supermarket. It's like
Yep.
one of the big things of the cost of living. So I cannot buy the same amount of stuff with the same amount of money. When I was growing up in China, we literally just put our money under the mattress.
Yep.
I mean, that's literally what my parents did. So I
very common.
actually remember that they were saving a few hundred Chinese yuan at the time. And after a decade, it was worth nothing.
Yeah.
And it's quite frustrating for them. And I'm like, well, that was the safe place for me to put it. And then inflation in China was going wild when the economy was doing better. It just essentially $200 or 200 yuan meant nothing after 10 years.
Yeah, and look at Thailand, look at a lot of the countries around the world in terms of how aggressively, if inflation goes on a bit of a run, so inflation reduces the purchasing power of money over time.
And purchasing power is as in purchasing power of assets, right?
Correct.
So I presume the way to combat that is to buy assets.
Correct. So even when inflation appears moderate, and in Australia we've got a fairly moderate sort of inflation target rate, the compounding effect over time, that's what you've got to look out for. Cash balances lose real value quickly. So your parents' cash sitting under the bed.
Mm.
So that old mentality of all of our parents, and you know, a lot of our doctors have ethnic parents overseas that save for the deposit, just continue to do that. I think you've really got to put it to good use. So again, Australia had an annual inflation rate of 3.8% in December, meaning $700,000 sitting in cash effectively loses $26,600 of purchasing power.
Mm.
It's a pretty big stat.
So even if house prices weren't going crazy like they are now, just on baseline inflation, your cash will get away from you.
Correct.
Right? Yeah.
Yeah. So even if you don't buy anything, you're actually losing money by not putting it to work.
So I remember I was reading something maybe a year ago. Someone was saying putting your money in cash isn't as risk-free as you think it is.
Correct.
Because you're guaranteed to lose money.
Yeah. Well, and I think you need to be really conservative in terms of where that money is flowing and what you're investing. But the younger you are, I think the higher risk you should take. And then over time, you know, you become a little bit more risk. You naturally just become risk adverse because you have kids and you've got a larger mortgage. But when you're young, you should really go for it. So a young doctor training, if they've got the capacity to buy one or two smaller investments, it doesn't have to be property, but other things, just get going. Because your tolerance to risk is a lot higher. So I like younger doctors taking on a little bit more risk when they're younger, and as they get older, they become a little bit more conservative, and we look at commercial properties and other things.
Right. And then when we're saying taking more risk, that means for a younger doctor, they don't necessarily need to get that 20% deposit.
No.
They just get 5% or whatever it is the bank is happy to lend them.
Yeah, because you're in a fantastic, your lending ability and your ability to get a loan at a higher LVR compared to just a normal person out there in the street is greater. So you really should be taking advantage of that at a younger age. I think it's really good. I think the next question is that we've had on the sort of Facebook community. How does property price growth compare to saving an extra 300 grand over several years?
Someone did ask that. I remember that question.
They asked the question, remember?
Yeah. I think it was, should I just keep saving? Because there was some people really don't like debt.
Yep.
Which, myself included, it kind of feels icky. because there's a pressure on you to keep paying off. But the issue is the inflation, and obviously the prices are going up. What's your advice on that? I presume.
So if a buyer waits 3 to 4 years to save an additional 300 grand, but property prices grow at 6 to 10%, and we know property prices have been going by more than 6%, the target home may increase by 3 to 600 grand. So effectively, if that market increases by 20% over 3 years, all that, that money spent time saving that deposit and your ability to buy in that particular area becomes a lot harder. So that's where it's really important that you have the data and you make sure that you're entering to those markets at the right time. Australian property prices have averaged 6.4% growth over the last 30 years. So the question is, can you save that amount of money versus the growth within the housing sector? Waiting often pushes the goalposts further away.
Yeah, I guess also that 6% average per year, if you're not investing into it, you're not getting that 6% either.
Correct.
Yeah.
Correct. So, you don't have to take on significant amounts of risk, but it has to go into the right asset. So houses have worked really well for our doctors over the years, but it's really important that you don't spend the next 10 years saving for that deposit if you have the capacity to get into the market.
Yeah. And I think you mentioned earlier about rent vesting, which is what I did early on. I think some people, which is totally understandable, looking to buy their forever home, especially when they're young, when it's what I thought I was doing. But then as you get older, you realize you weren't buying your forever home at all.
No.
It just ends up as an investment property. So I think the danger, and now in hindsight seemed much more obvious, was that I thought I was buying a forever home when obviously I wasn't. I was only in my 20s.
Yep.
So, yeah, I think that's probably a lot of other people. They're saving up because they think, I'm going to push myself, save up my deposit, and then buy this forever home, when in reality, all they need to do is get in the market.
Yeah.
Right?
And a lot of our doctors over the years, they get shifted into regional areas because they have to do obviously their, apprenticeship in some of the regional locations across Australia. They're the doctors over the years that have done really well because they pay their house off in Horsham or Warrnambool or Wollongong, a regional area, very quickly, and then they go and invest. But if you're a young doctor, by all means, don't go and buy that first property thinking it's going to be your forever property. I see it all the time.
Yeah.
Treat it like an investment.
Yeah, I mean, that's what I did. The mentality made sense at the time. But in hindsight, now we've got kids and looking for good schools. You weren't even thinking about those things back in the day.
80% investment, 20% for an area that you're comfortable living in. We might end it there today on that particular podcast.
I think the inflation idea really catches people out.
Absolutely.
Yeah.
The cost of living, and when you add that up over time, your ability to save becomes a lot harder.
Yep.
So it's something that people always talk about interest rate movement, and there's talk about interest rates actually increasing rather than going downwards. That is the real killer in terms of your ability to save and invest and go and do other things. So really, really track that inflation, understand what it is, and we'll leave it there.
Yeah, great. Thank you.
Thanks, Tony.